World's largest alternative asset manager and real estate investor, Blackstone, has recently been pouring billions of dollars into the residential real estate sector, and in particular, the multifamily real estate sector, which is obviously a very bullish indicator for multifamily real estate. And in fact, my number one opportunity right now in the real estate space is a multifamily REIT, and that's what I'm going to discuss with you today. Hey everyone, this is Samuel Smith. I run High Yield Investor, the top-ranked investing group on Seeking Alpha, and I specialize in dividend investing. I recently launched my YouTube channel in order to be able to share my unique approach to dividend investing with a broader audience, and I need your help to make it a success. So if you could please like this video, subscribe to my channel, and share with me in the comments below what you think of multifamily real estate right now, and especially the pick that I'm about to share with you. I'd be greatly appreciative. Thank you very much. Okay, so the pick that I want to discuss with you today is BSR REIT. And this is a multifamily REIT that is primarily focused in Sunbelt markets, with the vast majority of its portfolio being located in Texas, and in particular in the cities of DFW, Houston, and Austin. Now, why this is so important is because Texas is one of the most rapidly growing states in terms of in-migration from other states like California and New York, etc., alongside Florida. And the reason that there's so much immigration going on, and a big reason why, is because it's such a business-friendly climate. The government is overwhelmingly much more favorable towards businesses. And so a lot of companies are moving here from California. You may have seen that Elon Musk just moved SpaceX headquarters. He's moving more and more of Tesla here to Texas as well. And there are also other firms from New York and other places up north where the regulations are much more stringent, much less business-friendly, and they're moving to Texas. And also the housing here in Texas is much more affordable than it is on the East or West Coast. And so with a rise in work from home, it's much less necessary where you live to be able to be in close proximity to work. Also the rise of the online industry, where more and more online entrepreneurs and people are working 100% online. They're able to really live anywhere. And so Texas is a great place to live in terms of lower cost of living than some of these East or West Coast places. And so for those reasons, there's a massive influx of new people to Texas. And so demand for real estate here, residential real estate in particular, whether it be single family or multifamily, is booming and is expected to continue to boom for many years to come. And so that makes BSR right off the bat more attractive than many others because it's concentrated in these markets. And so it's likely going to benefit from strong demand for its properties and growing rents. And this portfolio is handpicked. It's only, a few dozen properties. It's not one of these massive multifamily REITs like Mid-America Apartment Communities or Camden Properties Trust or Avalon Bay or Essex Property Trust, etc., that have these very large portfolios. This is very concentrated, very handpicked. It's quite a high quality portfolio. It's also attractive because it's focused on Class B properties, which are very nice. They're some of the newer properties in the industry. They've only been around for a few years, so they still have a lot of accounting depreciation, which enables the dividend payouts by the REIT to be 100% return of capital, which is very nice for tax purposes. But also there's much lower maintenance CapEx required because they're newer properties. They're more attractive, they're fresher, they're more modern, and so they attract tenants for those reasons. But they're Class B, so they're a little bit lower price point. They're lower rise, they're garden style. They attract people, but they're not so expensive that people can't afford them. And that makes them especially attractive if we end up going into a recession or at least a period of extended stagflation, because people who may be looking to cut expenses, one of the biggest expenses for most people is housing. If it's a Class A REIT, a lot of those properties are more expensive. People lose their job, or their inflation is eating into their income. It's outgrowing their wages, or maybe they took a pay cut. And so maybe they'd want to downsize or downgrade from a Class A multifamily complex to maybe a Class B or Class C. Class B is going to see much less outflow of residents because of that. So it's a kind of happy medium between attractive, but also being very affordable. Another big reason to really like BSR REIT right now, and we dug into this in our conversation with them, is that there has been a oversupply issue facing multifamily in Sunbelt markets because of this massive population inflow. People are also trying to meet that supply with massive new developments going on. And so as a result, there's actually a supply glut right now. And that's led to some pressures on rents. In fact, many of the leading REITs have been guiding for falling same-store property income. However, in the case of BSR REIT, this is not as much of an issue because they are focused in some of the very fastest growing markets. And so they actually have not yet experienced declining rents. Yes, their growth has really stagnated, but on a year-over-year basis, as of this last quarter, their rents were still growing. And they may face some issues over the next few quarters with it stagnating or even potentially declining a little bit year over year. But by the end of this year, and especially by early next year, management fully expects their markets to see a return to rent growth, and their properties in particular should see that because they're well managed. Again, they're newer, they're fresher, they're more attractive to tenants. And so we expect them to not really suffer a lot of the headwinds that some of their larger and more diversified peers are experiencing on that front. Another reason to really like them, and this was also discussed in the interview, is that there's a major property tax potential tailwind for them. one of their biggest expenses is their property tax expense. But in the state of Texas, this past session, there was some meaningful property tax relief, which was passed and helped them a little bit. But there's also a growing tide of momentum for this next session to see even more of that, because in the recent Republican primaries here in Texas, there was a strong wave of anti-property tax candidates for the state legislature that won their primaries and are in very safe districts for their party. And so they're very likely to get into office. There may be a new speaker, very possible new speaker this next session that will be more anti-property tax than the previous one. The governor and the Senate are also increasingly favorable towards cutting property taxes. So we don't know exactly what's going to happen, but it seems like a safe bet to expect that there's a high likelihood of property taxes falling further this next session, which should be another big tailwind for the REIT. Another reason we really like them right now is simply the fact that multifamily is such a hot asset class, especially here in these markets where there's strong population immigration, that there are so many investors from around the world even that want to get in and invest in these properties. And so that's helped keep cap rates fairly low, even as interest rates have risen, which is protecting the net asset value per share story for BSR REIT, keeping it in a pretty good value range, and also enabling them to potentially, if they wanted to sell some properties, they could get a really good price for it, or if they were to be acquired, get a good price for their value. So again, it's a hot asset class, the very attractive long-term growth outlook in these markets, and their rents are holding up nicely, and there's even potentially a property tax tailwind ahead for them. Another thing we discussed on the call that is something that we also really like about BSR REIT is their balance sheet is in pretty strong shape. Now, they're not, one of these A-rated REITs like Mid-American Apartment Communities, but they do have a fairly low leverage ratio. They have interest rate hedges in place that are protecting them from interest rate headwinds for the near future, and they're retaining a lot of cash flow. Their payout ratio is only a little bit over 50%, which means that they're retaining a lot of their cash flow and are therefore able to pay down their debt. They're going to be redeeming their convertible debentures that are coming up to protect against either stock dilution or additional debt being taken on. And so this really eliminates any of the near-term interest rate debt risk that they have, because even though interest rates are higher, as their debt matures and comes up for refinancing, they're able to just pay it off if they want, or they can refinance it opportunistically if they so choose. And so that really protects them from that risk, which is a major risk that's been hitting a lot of REITs lately. Another reason we really like them right now is, once again, that payout ratio is so low that it's below their target. Typically, they target a low 60s payout ratio. A lot of their peers have a 60s to 70s percentage range of payout ratio, where theirs is in the low 50s. And so that gives them considerable flexibility as a board where they could accelerate their dividend growth. And in fact, the CEO mentioned that this is quite possible on their earnings call, that they're actually going to do this. Another reason we really like them right now that we discussed on the interview with the CEO and CFO was really just the idea that their balance sheet, again, they're paying down debt. They're not interest rate sensitive, but they're continuing to lower and lower their leverage ratio, which, as their CEO put it, they're loading the gun so that they'll have a lot of dry powder, a lot of financial capacity available to them. So if and when the environment changes, interest rates fall, making acquisitions and new developments more attractive in an economics front, they are ready to go in, and they will be able to grow quite rapidly once that happens, which is an unforeseen tailwind. And in the meantime, they're actually buying back stock quite aggressively because their stock trades at a very large discount to their net asset value. The stock currently trades in the United States over the counter markets around $12 a share, and the net asset value estimate for those is roughly around $17 per share, again, give or take a little bit depending on how you measure it. And so as you can see, there's a very large discount in their shares right now. And so buying back stock is effectively like them buying their high quality, Class B attractive properties in these attractive markets at steep discounts to the private market value. And so it's a great use of shareholder capital. So we really like that about them. And they're planning to continue doing that along with paying down debt for the foreseeable future until, again, the industry dynamics change such that it makes more sense for them to begin acquiring properties or developing new properties again. And finally, we really like it, just the fact that we are very well aligned. Management is well aligned with us as shareholders because they own a huge amount of the company. They continue to buy more as they have opportunity to do so. And so, again, the fact that they're buying back stock right now, when a lot of their peers are not, that just, again, shows that management is so well aligned with shareholders. And so that enables us to sleep well at night, knowing that we have a professional management team that is heavily invested alongside us. And so we can have confidence that they're going to make decisions in our best interest. And really, along with that, because they trade at such a deep discount and they're a relatively small REIT, especially compared to many of their larger peers, we think that they could potentially be an attractive acquisition target because, again, they're not too big. They offer that attractive Class B exposure that some of their peers like Camden Properties Trust and Mid-American Apartment Communities are looking to increase their Class B exposure. And so they'd be potentially a really good fit. Again, that deep discount to NAV, they could sell at only a very slight discount to NAV and still be very accretive on an acquisition basis to these larger peers, but also offer extremely large upside to us as investors at the same time. And also, while they do have a strong balance sheet, they don't have a A- credit rating. And so these larger REITs with higher credit ratings could buy them and refinance their debt potentially if they wanted, or at least some of it at lower rates, and to further unlock value for them, again, making them even more compelling acquisition opportunity. But even if the acquisition does not take place and they just continue to hold their portfolio, even if interest rates don't come down, they can just keep paying down debt, keep buying back stock with their retained cash flow while paying out a nice dividend, potentially accelerating that dividend growth rate, and still generate very attractive returns for us for the long term. So I view it as a heads I win, tails I probably still win type of investment. Sure, no investment is risk-free, but with BSR REIT, you really can buy and hold forever without having to worry too much because, again, these markets are so attractive. But you do have the potential near-term upside catalyst of a company like Mid-America Apartment Communities, Canada Properties Trust, or some asset manager potentially buying them out. So for those reasons, it's my favorite REIT right now. And if I could only own one REIT, it would be BSR REIT. I hope you enjoyed this video. And if you did, I'd really appreciate it if you'd give it a like. You let me know about it in the comment section below, or if you want something different, if you didn't like it, if you disagree with my view of BSR REIT or multifamily, let me know in the comment section below. And please, most of all, subscribe to my channel so you can get future content and help me to grow as well. Thank you very much.